Welcome everyone to Name Confidential Live.
Hey, welcome back to another episode of Name Confidential. I'm Branden DuCharme, one of your hosts. I'm joined this week by our new member, John. John, is it John Beldy? I don't want to get it wrong here.
That's correct. You got it right the first time.
John Beldy, out in Denver, Colorado. John's one of our new members, recently started participating in the Name Exposure Index, which came in this week at 87.87. Exposed overall to equities. And last quarter's average was 85.81. So sort of as a whole, as active managers, we're a little bit more exposed, a little bit more bullish still than we were as a whole last quarter, which is a little interesting to me. And boy, has there been just some absolute craziness in the markets, quick reversals, both up and down in the final hour of trading in the markets recently. Volatility spikes and drops, and that cues up, I think, a conversation really well for today. Bringing John on, as he has had a career dealing with a lot of derivatives and particularly options. John, really quick, why don't you just take a couple minutes to tell everyone who you are and some of the stuff you've done throughout your career.
Sure, Brandon. Thank you for having me on today. It's a pleasure, and I'm looking forward to this next half hour. I got my career started as an options market maker on a couple different options exchanges. So, just to give everyone an understanding, it was those people that yell and scream at one another in the pits is what we call them. I did that for about 7 years. So I got a great experience and great exposure to, all about the options market and how they are priced and how they utilize inside clients' portfolios. And then from there, I took a position with Charles Schwab as a manager on their options trading desk, and basically working with investment advisors on how to hedge portfolios or concentrated positions, how to take advantage of the market movements and what to do when volatility spikes or when it's really settled for a period of time. So I got a great career in terms of understanding, options in their technical form, and also how options are utilized and with clients and how to hedge off that risk. And then in 2020, I pursued a vision of mine and to start my own RA and to work with clients more closely on how they can really hedge off a lot of that equity exposure they have inside their portfolio, and take advantage of some income generation opportunities, all centered around using options.
When you say that, like the thing that comes to mind is covered calls. Um, Particularly, I think hedging around concentrated positions is something unique, and I think there's, from a personal finance side, there's like a lot of reasons why people might want to hedge around concentrated positions for tax purposes, right? Long-term holdings in a company. If you have maybe it probably wouldn't apply because of the nature of it, but like any kind of restricted positions that aren't tradable at the time, you want to manage your risk around it, right? There's some really interesting use case for that. But the hot topic in the market has been, the idea of covered calls, right? And generating this yield on a portfolio by writing covered calls. You recently wrote a paper and submitted it to NAAIM, in which you talked about it briefly. And there's a lot of excitement around covered call writing because it can be viewed as this like one of two ways, right? It generates this extra yield. It's this extra free money you get for kind of selling the insurance. Or if markets are coming apart, like you outperform because, yeah, you took the downside capture of the underlying asset, but you got paid some insurance premium on the way down that you never had to really pay out on. So it kind of padded you or gave you that buffer on the downside. All right, that's kind of the idea. If you look at those, they really tend to underperform though. So in your opinion, with your expertise, what's the use case to use that appropriately when building portfolios or trying to manage risk?
Yeah, if we look at like the last 13 years or so, it's been a bull market. And so anything that has protection inside of a portfolio is just going to be underperforming significantly. But we just don't know when those markets are going to come apart. Like, for example, the last couple of weeks here, we've seen that happen. We don't know when markets are going to stay flat. And we especially don't know when markets are just going to spike. So the use around covered calls is really to, have that insurance premium inside your portfolio. And if you think about it this way, if I'm running a covered call strategy that has it's rules based, so in other words, there's some rules inside of it, where I can go out and generate some income and use that income to offset some losses. That's going to help me when markets go down a little bit. When markets are going to start spiking up a little bit, I'm going to capture on my core portfolio holdings, those ETFs that I have inside that. Now, I might lose a little bit on the upside capture, but I'm reducing the overall risk of the portfolio. And most investors, when they look at risk or return, they're aiming to reduce their risk. They want to have some equity-like returns for sure, but they just want to be able to sleep better at night. And they want to be able to say, okay, we're going to get singles and doubles here. We're not going to look for home runs. And when the markets do go down, there's a way of offsetting those losses. And it works in two different ways. First, the initial way is that we're offsetting losses because we sold a call against an underlying position. And of recent, in the last couple of weeks, when volatility spikes, the way options work is that the option premiums will increase in value significantly relative to where they were. So now we could take advantage of that excess premium on those options to further enhance that yield on that portfolio while still maintaining a long bias approach. When we have these market movements to the downside of say 5, 10%, most investors don't know what to do. They basically just cross their fingers and say, we hope the markets go up. Well, with the covered call strategy, we're actually working to, offset some of those initial losses and maintain that long approach. So it really helps out in terms of easing the investor's mind about what are we doing right now with these markets, how turbulent they've been. So that's the way that the covered call strategy works best.
So do you take a systematic approach on that, or do you do like actively watching and actively managing on a day-to-day the call positions?
Yeah, it's not mechanical, so it's very flexible. So there's some indices out there that are very mechanical in approach. In other words, on expiration, they'll go out 1 month and they'll sell an at-the-money call option and just do that accordingly. My strategy is centered around being flexible. So when markets move around, when volatility moves around, I can look at that, intrinsic value, and I can look at the implied value, implied volatility values, and go, all right, here's a good way of taking advantage of this. Let's roll our strategy into this expiration or this strike to generate additional yield on the portfolio. So there's some rules centered around when I'm going to go about, how far I go out, whether it's 1 week or a couple months. And there's some rules centered about okay, when do I roll these options, given certain criteria. But for the most part, the active managed part of it is the flexibility in nature.
Okay. Have you, you've been doing this a long time. Obviously, we all have a bias towards active management rather than systematic. Do you find that there's a significant edge in that space? Like people will argue, if you're picking stocks, right, it might be significantly harder to outperform the benchmark. Whereas if you're a bond manager, it's not, it's not unheard of. It's actually statistically in your favor to beat the benchmark, right? What's it like in the covered call space, right? Is it easy to outperform or challenging?
Yeah,
what's the situation?
So, when you get the ask the question, okay, so what's your benchmark? And with a covered call strategy, it's kind of challenging to get a benchmark because there's nothing truly out there that's like that, right? Everyone goes to the S&P 500 versus their long portfolio. Well, no one really truly has just the S&P 500 in their portfolio. So that right away, it's not really aligned comparing apples to apples. With a covered call strategy such as myself, there's a benchmark out there that you can look at the S&P 500 buy right index and say, okay, how am I performing relative to that? But once again, my strategy has multiple broad-based ETFs embedded in it, not just the S&P 500. So to answer your question about is it hard to beat the benchmark or not hard? Well, it's a challenge to say, okay, how am I comparing my overall portfolio, which is well diversified, having large cap, small cap, and technology inside of it, versus just large cap portfolio. So it can be challenging in that, but the beauty of it is that with having the flexibility, it's a little bit easier in some ways for me to take advantage of these big movements. For example, today we had a huge movement in the overall markets to the upside, late in the day, but early in the day there was the volatility was relatively high in the option world, so I was able to take advantage of that and sell some premium, excess premium, if you will, relative to what they were trading at. So.
Okay. So, have you ever gone and looked at like, okay, well, how well does the way that I do it compared to if I run the same, like a systematic approach, but on my assets? Have you ever gone and looked at something like that and determined what your, like edges over a fully mechanical system?
Yeah,
It's like really hard to backtest something like that.
it's very challenging to backtest, because with any backtesting or data mining, if you will, it usually works into your advantage when you backtest, right? There's no real yeah. Then it's like then you could start changing the rules around as you go. But I look at it this way: is that if you have something that's very mechanical, then you're not really taking advantage of market dynamics, and you're not taking advantage of the volatility space itself. And that's pretty much, that's the antithesis of what, active management is. So I really haven't had a chance to backtest it that way. It would just, I don't think it would work,
Yeah. Options are so difficult. I always find like the great irony is the people that go and buy they buy an option, say like before NVIDIA earnings, right? It's like, oh, it's Tuesday, NVIDIA's reporting on Wednesday or Thursday. I'm going to buy, I think it's going to go, they're going to outperform. So I'm going to buy a call or I'm going to buy a put. And then, it's like a earnings call happens. There's not a major move in either direction, not super significant, right? Like at least for NVIDIA. And all of a sudden, like, doesn't matter kind of that it went up or down a little bit. It doesn't matter if you bought the call or the put, they both lose money.
Yeah. That's,
right?
yep. Well,
Even if it goes your way, you still lose money.
Yeah. So before earnings announcements on, on stocks, there's a buildup of anticipation of what's going to happen. And so when you have that, you have, the implied volatility of the option that's increasing in value as well. So even though the stock hasn't moved, the options have increased in value because of the, implied volatility increasing. And then once the earnings comes out, well, all that deflates back to normal, right? To where it was trading well before the earnings announcement. So it's, it's kind of counterintuitive, but it's like before these earnings announcements, you almost want to sell these premium versus buying the premium. Just as the example you point out, even if they announce, relatively poor earnings, the stock doesn't go down by a significant amount, and you didn't make on the put that you bought. So it can be a challenge for investors to understand like when and where and how to go about taking advantage of stock movements using options. Going to the covered call strategy, when there's a buildup in volatility like we've experienced, I'm selling premium. So I'm selling more premium than I would be selling beforehand. When you're going to play the earnings announcement, you got to play it well before that, the earnings call, or you can take the opposing view and sell that premium, which is very risky and it's not really advisable to the average investor.
Why is that? What builds that risk?
Well, if they're selling uncovered options, right? If they don't have if they have an account with $100,000 in there and they want to take advantage of, say, NVIDIA's excess premium, and they're selling uncovered call or uncovered put, and the stock does move significantly, against them, then they're going to be out a significant amount of capital, right? But if they had NVIDIA stock in there and they sold call options against that, they could probably take advantage of the premium over where it was normally trading. So.
Yeah. Do you think, so you've been doing this a long time, and with the rise of covered call strategies, a lot of like, at the end of the day, a covered call strategy that's systematic in nature, in my opinion, is you're really just short volatility, right? So, some people might express that by shorting the VIX, right? I suppose, right? Some people might express it by just, selling that systematic call option. It's a covered call, but what they're getting is the roll down in the curve, essentially, from selling that implied volatility out in the future, a little bit of uncertainty, and they're collecting that premium. So as there's all these sellers now, going back to like sort of supply and demand, you have all these sellers selling volatility into the market. Does that dampen? I mean, do you think that could be lead to the dampening of volatility the last couple of years? Does that make I don't know, maybe I'm not saying it clearly or describing my thought, but you know, if a bunch of people are wanting to sell call options to collect the premium, like there has to be buyers to want to buy the call premium, right? To
Mhm.
buy the call. Otherwise, there's more sellers than there are buyers, and so the price goes down. Well, the price going down drives down that implied volatility number, correct?
Yep. Yeah. So, I mean, like I said, over the last 13 years, we've had such a bull market that there's been no real, huge, with the exception of COVID and, and of recent huge spikes in volatility.
Mhm.
So there hasn't been huge demand of like playing the position one way or the other per se. But, even though you are, short vol in some ways, with a covered call strategy, you're net long. So
Yeah.
you're actually, you want the market to go up. Now, the artistic approach is that, okay, so how long do I want to be relative to my call option, right? Do I want to have this call option 2% out? Do I want to have it 10% out? Then I'm not so much short vol anymore, which I am, but I'm also playing that long position. So
Mhm.
the tight of that band between, the spot price and my call option is going to really be, I'm going to increase the premium I'm going to receive, but I'm also saying like the market's not going to move up as much in that period of time.
So do you find it to be more attractive over time to be selling calls, at the money or out of the money or deep in the money?
I don't sell call options that are in the money. It's all either at or out of the money. And it depends on the market cycle. It depends on the volatility surface we're in. That
Okay.
will dictate, where I'm going to go out and say, okay, I'm going to go out, for example, 2 weeks and sell a 3% out of the money call option, let's just say. And, just, keep my eyes on it and analyze it for its movement and see how it's performing. And then from there, just roll accordingly. But it depends on the space. Like we had today's movement today over the last week. It's been pretty significant. That's done a good job of increasing premiums. So you can take advantage of that. And with the markets moving down, you can say, well, we could bounce back a little bit there. So maybe the band might be a little bit wider. So it just depends on the market cycle and where we are in the vol space.
Okay. Okay. Um, and what about timing wise, right? So like, do you find it in your experience more beneficial over time to sell, shorter options or longer options or really long options? Obviously there's been a lot of noise the last couple of years about the 0 day stick expiration options, right? Like, and there's funds now coming out that like they just sell that every day. You
Yeah,
buy that every day. It's like that
that's
a little weird
yeah,
to me,
that's
but
it's I think it's a good day trading tool. I'm not sure about portfolio management tool, right? Then you're really like getting into the account and there's a lot of mechanics that go on and putting on a portfolio management strategy that's centered around using options. Um, you know, determining how far out you should go is where the experience comes in. Like, all right, so where are we in the market cycle? What's the portfolio value? How far am I going to go with each expiration? And then how do I get the most bang for the buck? Everyone, there's what's called leaps out there that go out a year. And at first glance, they can be attractive because of premium, but that premium you're not going to realize until the last couple months. So now you're like married to this position for a year in order to collect that premium. Whereas if you go out shorter, let's just say for argument a week, you're going to realize that premium inside of a week, but there's not that much premium there. So that's where the analysis comes in. All right, so how far out are we going to go with the expiration and with the strike?
okay. And there's a big difference in volatility in single names versus sectors versus broad market, right? Where do you find, have you found or identified any kind of like sweet spot to be paying attention to? Like, hey, if you get into these technology names, the volatility is so high, there's really a lot of opportunity versus like different sectors, like, energy can be highly volatile, but, not always appreciate a lot.
Yep.
Um, versus like, maybe it's dampened down in if in like the S&P or something like that, but because it's dampened down, it's maybe like easier to sort of win or have, profitable trades.
Exactly. And so all that, what you explained, it makes perfect sense. Single name, options, they're very volatile and it can be very lucrative, but they move around a lot, right? So to give you the example you gave with NVIDIA, if you had a covered call option on NVIDIA, and you just put it on, NVIDIA can come out tomorrow with some great technology enhancements and the stock goes up 15%. Well, you've made on the underlying, but you've lost significantly on the option itself. And then if you take the other side of the spectrum, which is broad-based indices, not much premium in there. They don't move around as much as a single name, but you can manage that risk a little bit tighter than you can on a single name. Indices don't go bankrupt. Indices don't get taken over, right? Indices don't move up and down 10% on a given day. So you can, with our strategy, it's singles and doubles that we're looking at, and that's why we tend to gear our strategy towards broad-based ETFs.
Okay. And when you say broad-based ETFs, do you have any experience doing this with sectors? Like, is that still broad-based for you? Or are you saying, just the larger,
Just the larger ones,
all
yeah.
sector sort of market index?
Exactly. Yep. Like the
Okay.
S&P 500 or the Russell 2000 or the Nasdaq 100. That's going to be, if you look at any client's portfolio, the majority of that is going to be in there. Whether they're picking, whether the advisor is going to be picking stocks or sector ETFs or what have you, they're going to go and get out into the large cap, small cap, and technology space. I'm doing that in a very cost effective and efficient manner by just buying the ETFs themselves.
Yeah. So if somebody was going to go out and look for a way to implement, covered calls or options into their portfolios, either as a portfolio manager or an allocator of funds, right? So like most financial advisors, what are some of the things that people should be looking for right away, and trying to identify to make sure that they're making, wise decisions, strategically, mathematically, and the rest?
Yeah, time commitment. It's not something that you just put into your portfolio and then don't pay attention to it for a couple of days because a lot can happen. So you have to have eyes on it every day, just for the analysis. Then the experience and the knowledge that goes in there, like what happens during certain volatility events, how you can take advantage of them, and then understanding your risk parameters. How much are we willing to lose on a given option strategy, if you will, on a given time, that makes sense in the overall portfolio. And then the scalability of it, whether you have a portfolio of 100,000 or 5 million, how are you going to go about and using options in that? Are you going to peg it to just one strike? Are you going to use multiple strikes over multiple months? And then that comes into the complexity of managing that strategy itself.
It is all good stuff.
Uh,
I think, yeah, what's interesting in NAAIM as an organization is that, I think I'm one of the few guys that started out in the organization. It's just a straight allocator. I wasn't a portfolio manager. I didn't have a stock picking strategy or an edge in, whatever, right? What I found I ended up building a skill set in personally by getting around people in NAAIM and getting around other managers was understanding, how different strategies work together and, what are the complementing components of portfolios. And so now, like, I sharpen my skill set as an allocator, and I think I build really nice, well put together, portfolios. Oftentimes, implementing the work of other portfolio managers, right, through their, ETF products or SMAs or, whatever it might be. And yeah, so I look forward to having you in the organization, John. It sounds like you really bring a deep skill set in understanding the options markets and how they can be used to help advisors and portfolio managers glide their clients along to whatever their definition of success is. But I think in general, we can appreciate that means, some form of more return and less risk, right?
Yeah, definitely, most definitely.
So anyways, well, I look forward to seeing you around. Are you going to be down at Uncommon Knowledge in Costa Mesa in May?
I am looking into that. I haven't, made concrete plans just yet, but yeah, that's on my radar right now.
Okay.
Yeah,
I will certainly be there, and I found that those conferences are highly beneficial. I've really learned a lot at those conferences and made some wonderful connections with great other people in the industry. So
perfect.
hopefully we
Yeah,
do see you there, John, and
I hope so too.
forward to meeting you.
Yeah, thank
So,
you, Branden.
all right. Thanks everyone for tuning in, and we will see you next Friday.